Good afternoon, everyone, and welcome back this afternoon. My name is Jean Beck. I'm the CEO of Hilton Head Area Realtors, and we are happy to be one of the sponsors to the program here today of Pivot with Power. I have the pleasure to introduce to you Dr. Elliot Eisenberg. He is an internationally acclaimed economist and public speaker specializing in making economics fun, relevant, and educational. Dr. Eisenberg earned a BA in economics with first-class honors from McGill University in Montreal, as well as a master's and Ph.D. in public administration from Syracuse University. Dr. Eisenberg is the chief economist for Graphs and Laughs, a Miami-based economy consultancy that serves a variety of clients across the United States. He writes a syndicated column and authors a 70-word commentary on the economy that is available at www.econ70.com. Dr. Eisenberg was formerly a senior economist with the National Association of Home Builders in Washington, D.C. He has spoken at hundreds of groups and associations, serving as keynote speaker on topics including economic forecast, economic impact of industries such as home building, consequences of government regulation, and other current economic issues. So Dr. Eisenberg, we are pleased to have you with us here today in the Hilton Head area and welcome you to our program this afternoon.
Thank you so much, Jean. I really just wish I were actually in Hilton Head, quite frankly, rather than my
day. So you're not missing much today. So
same here in Miami. So we're good.
Okay.
Let's and thank you to the Hilton Head Multiple Listing Service for also arranging this. So there's lots of people involved. Thank you to everybody. Let me begin. There's lots to talk about. We've got a lot to cover. There's a lot to say. Let's begin by quickly reviewing what GDP is. GDP is all the goods and services produced in the US, right? And there are four terms in GDP. C, household consumption. I, corporate investment in plant and equipment. G, government spending. And the bracketed term are net exports, exports minus imports. The key thing is they're not the same size. C is the biggest one, household consumption. It's 68, 69% of GDP. It's the thing we need to move now. It has to sustain us through until we get the vaccine. We're not going to get enough corporate investment. Government spending will hopefully give us money, which will help C go up. We need G to go up to push C up. Exports, they're not going to do much. They're going to hinder us a little. I'll discuss why later on. The show really is C, 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 C. We need G to give us C. We need job growth to give us C. Everything's geared around pushing up that 68, 69% of GDP. And in part, things are quite good. Our economy really is somewhat schizophrenic. And you'll see what I'm talking about here. This is the first graph. And this graph looks at real retail sales. They're unbelievably good. You can see here, they were marching along for years and years and years. The recession comes, it's very short, very brief, and then things recover very rapidly, and then we're off to the races. And it even went up last month by 1.9%. This growth here is somewhat unexpected, but put this into perspective. This is the level of sales, but look at the rate of change from month to month, and you'll see that we're dramatically slowing. So we had, March, April, May, June, July, August, September. We're kind of now getting down to this relatively low after this really boom, really big movements. And now it's delicately ramping down. This last month, September, happens to be particularly good, but objectively great, but it's not going to change the needle and move GDP by very much. And this was a Q3 number when the money from the government was still sloshing through a little bit through. Now, look at the next graph I'm going to show you. It's automobile sales. They've also come roaring back. Not quite as good as retail sales and not nearly as good as housing, which we'll talk about later, but it's made a terrific recovery. We've almost entirely recovered. Now, this is partly because of pent-up demand from before, and also partly because of the coronavirus. People are not taking public transit. People are moving to suburbia and exurbia and rural areas, and therefore they need a car when they didn't need one before, or now they need two as opposed to one. So this data here, like the housing data, is not quite a good indicator as the health of the overall economy because it's being contaminated. And I use that word appropriately here, by the coronavirus impact. So we're saying, well, we want more house, we want more car because of Corona. If it weren't for Corona and I see housing sales where they are and automobile sales is where they are, I'd say the economy's terrific. But we know that's not the case. And we know that's not the case in part from data like this. Look at the University of Michigan's Consumer Sentiment Index. It's the one on top. The one on the bottom is relevant, don't get me wrong, but I want to focus on the one on top, but they're both, as you can see, quite similar. You can see prior to the recession, it was hanging around somewhere around 98, somewhere between 95 and 100. It really weakens during the recession, right away in March, April, the lockdown period, and then it begins to slowly improve. And it's been a herky-jerky process, but there's certainly some steadiness to this process, and the latest number is the best we've had in a while, but we're still quite a ways down from where we were. So this data here does not look nearly as good as this data or this data. So parts of our economy have come roaring back. We're buying things, we're buying cars, we're buying houses, which we'll talk about later, but we're not doing other stuff. The other stuff we're not doing is the obvious stuff. We'll talk about it shortly. And why aren't we doing other stuff? We're not doing other stuff because of coronavirus. Remember, this is a health crisis, not an economic one so much. The economics is a result of the health problem. We're afraid of going outside and getting sick. We're afraid of visiting our parents and killing them. And as a result of that, we're doing all kinds of things we didn't do before and not doing things that we used to do before. So, and the thing with the coronavirus, as you can see in this graph, the red is what's most important. The blue is number of tests that we're taking, and we're at about 1 million tests. That's a good number. So we have a pretty good notion of what's going on. The issue, the problem, the concern here is in the colder climates. What's going on now is coronavirus numbers are going up. This is also the after effects of Sturgis in South Dakota and South Dakota and Wyoming a little bit. You can see the numbers are going up. So there's concern here of a second or third wave of coronavirus. If that was the first wave and that's the second wave, maybe this is a third wave. We're not sure. Europe's having a third wave. Other places are too. So we're a little nervous. This is putting us back, and we're not doing stuff that we would have done. As a result, we have some more money. The government has given us money, and we're buying cars and buying houses, and retail sales are good, not necessarily in a store, but Amazon or whatever it is. And the question now becomes, when's the virus going to go away? When are we going to have a vaccine? It looks like the vaccines are probably going to come sometime in Q1. We've gotten a little more optimistic. You can see way back here in May, the thinking was it was going to come much later in 2022. Now people are by and large thinking it's probably going to come much sooner. We may even have some data end of this month or end of next month. We may have emergency use in December, but before FDA approves the drugs and it gets distribution and so on, this is not going to be overnight. But somewhere, hopefully early Q2, we probably will get some vaccines coming in. We'll get some jabs in our arm, and that will be a good thing. But until then, we can't get our economy totally back on track. Even though retail sales and car sales and home sales, which we'll talk about, are terrific, look at data like here. Look at this. Gasoline consumption, 95%. A lot of our economy is at 95%. Disneyland's not opening up. Six Flags not opening up. All these amusement parks, bars, restaurants. You want to go to a baseball game, not hockey game, opera, ballet, tractor pulls, not so much. How about airplanes? I don't really think so. Not really happening. So this is where we are right now. This is where we were last year. And this year is the percentage of where we are compared to last year. So we're roughly 35% of where we were last year. This is not heroic. We're not going to go because we don't want to go on vacation because we don't want to touch anybody. We're buying recreational vehicles as a result. So we're buying stuff. We're not going places. The part of the economy depending on going places isn't really moving. That's the problem that we face. This is hotel activity. Hotel activity began to improve nicely. Good. And then the slope begins to slow down. And it's totally flat now. So we should be here, and we are here. We should be there. That's the average of the last 20 years or so, the blue one. We're well down and not making any progress. Our economy is slowing down. The slope, as a slope gets less steep, that's a sign of slowing. And that's happening everywhere. That's why we need the government stimulus that I've already talked about, and we'll talk about more. Here's another example. This is jobs by a website called Indeed. And you can see things fall off a cliff in March and April. They begin to improve. The slope through August 1st, where my cursor is about that steep. After August 1st, the slope goes like this. It's less steep. That's all there is to it. Our economy, the low-hanging fruit has been pulled. It's going to get increasingly hard to get GDP to grow. Q2 GDP was the worst ever. Q3 maybe the best ever. And Q4 very uninspiring, especially if we don't get government assistance. And I'll explain to some of you now why. This graph shows us total consumption, not just retail consumption, not just automobiles, not just the really good sectors, but all of that first term in GDP, 69%. And what you see here is it's starting to slow down. The growth is moving up, but it's starting to curve out. It's not so much of a V anymore. It's now moving more like that, right? This is how much we're spending. But notice the month over month change, like I showed you about 10 slides ago. You can see here, March, April, May, June, July, August. We don't have the September numbers yet. We'll have them shortly. You can see here, the improvement is rapidly shrinking. That's why if we go back one graph, you can see here, it's curving out. Moreover, if we don't get government assistance, this number here, total spending, will depend exclusively on this number. This is earnings. This is income and revenues and all that kind of stuff, right? Royalties, whatever, interest, dividends. You can see here, we've made up half the loss, but there's still more to go. So this loss here, we've only made up about 50% of the total loss. That's the total loss. We've made up that much. It's about half. But the other graph here, we've made up more like 80 or 85% because of the government assistance. We're not creating jobs fast enough to get this graph here up as good as the prior graph. Might corporations help us? Will corporations ride to the rescue and give us lots of stimulus by spending lots to build factories? No. You can see in this graph here, factory utilization rates. They're kind of stuck here. They were here before we started at 77%, roughly. They fell into the low 60s. They're now in the low 70s. But if firms weren't doing a lot of corporate investments in plant here, and they weren't, why do you think they're going to invest more at this lower level? They're not. They're investing in equipment. They're buying stuff, lots of PPE and plexiglass plates to protect diners from other diners and electronic door openers and all kinds of technology, but they're not building plant. So this sector is not going to help us much a lot. How about corporations? Are they going to give dividends and stock buybacks and inject money into the economy that way? Not so much. You can see here, share buybacks in light blue have dropped dramatically, and dividend payments are down a little. Banks are being prohibited from giving dividends, essentially, not exactly, but largely by the central bank to hold on to their money in case things go bad later on. So we're not going to get much help from corporate investment. Consumers are spending, but they're running out of money to some extent, right? So we need government assistance. We need Nancy Pelosi and Steve Mnuchin to make a deal. This would be very good. The sooner, the better. We can argue how much, we can argue to who, but we need some assistance in that department. Now, in terms of exports, not going to help us much. Yes, the dollar's gotten weaker, which all else equal is a good thing, but we don't export a lot of stuff. We export services. We export tourists who come to America. That's an export as far as GDP is concerned. They're bringing money in, right? They're not coming because of Corona. We export education. Foreigners come to get educated and schooled here, but they're not coming. We sell movies to the world, and they show in movie theaters, and they pay us dividends and royalties. That's not happening either. And on top of that, the trade war with China continues, and it's clipping a little bit off GDP too. So exports, imports, they're not going to help. They're going to hinder slightly. If you put all this together, all of it, what do you have? You've got this. This is a pretty good measure of immediate day-to-day, week-to-week data that we can get, high-frequency data. And you can see initially the slope is very steep, very steep. And then it goes down. It's still steep. It goes down. It goes up, it goes down. It's starting to weaken. If you look at the slope from here, where my cursor is, to there, the slope is much less steep. It goes from there to about there because growth is slowing. If you put it all together, GDP growth in Q2 was negative 31.7, the worst quarter since the Depression, before the Depression, actually. Q3, we don't know what it'll be exactly, but I bet it'll be over 30%. It'll be really, really, really strong. But Q4 won't be. Q4 will be 3 or 4% if we don't get government assistance. And if we get some government help, unemployment insurance, people who are not working and so on, we might get 8 or 9. That's a big difference objectively. Don't belittle the difference. That's a lot. What will this recovery look like? It's looking like a check mark. You can see the rapid decline in Q2, a rapid recovery in Q3, and then the slow slog sets in. So think of it more like a down, on up, and then up, and then it goes gradually higher and higher, but slowly. It'll take us till the late next year to get GDP back where it was here before the recession began. It's going to take some time. You can see here roughly Q4. Could be a little longer, a little less, but this is we're making progress, but we've got a ways to go. How about labor markets? They were tight, but they're not tight much anymore. They're just not. You can see here the amount of job loss, unemployment. Unemployment's come down precipitously. It skyrockets, and this is an underestimate because the Bureau of Labor Statistics made some mistakes in their estimation of unemployment insurance, unemployment rates. But that aside, unemployment comes way down. It's now 7.9%. Great. That's really good news. But it's not as good as you think. And the reason it's not as good as you think is because the labor force participation rate in black for men and women together is not doing so great. It comes way down, it goes way up, steep, and then the slope goes way down. You can see that in the very far right. What is going on? What's going on? Men are on top in blue, women are here in red, and the women's number is declining. Why? It's declining because kids aren't in school. If kids don't go to school, women who have to work outside the home don't work. That's the problem. And we're starting to see this effect. The latest month, which is September data, which I'm showing you, the men's number declined a little bit. The women's number declined 5 times as much. I believe that this is what we're starting to see here, is women can't go to work. They have to stay home to take care of their kids. This hurts the economy, it hurts the household, and the kids are suffering because they're not in school with their friends and learning in a professional environment. This is a bad thing all the way around. But this decline in the labor force is making the unemployment rate decline look particularly good. And another way to look at this, our economy slowing down, is first-time claims for unemployment. So these are people who were working, who are now unemployed. And you go to the office and you fill out a form, you do it online, whatever you do. In the first couple weeks of the recession, unemployment peaked out at almost 7 million in a week. We lost more jobs in 1 week in this recession than we lost in the entire global financial crisis of 2008. Since then, the numbers have been steadily declining. Well, a little bit up here, down, up a little bit, down a little bit, but going down very slowly. And last week, they actually went up again. The number's now about 900,000. Prior to this recession, the worst number in history, going back to data when it began in the early 60s, was 695,000. This number here was 7 million. Right now, it's at 900,000. If this number today was the first number in a recession, we'd say, wow, this is a humdinger bad recession, let alone all these weeks prior. And the problem is it's not getting lower. If we're losing 900,000 jobs a week, that's about 4 million a month, right? We have to create roughly 5 million to get 1 million new jobs a month. This isn't so easy. It's going to get harder. That's why unemployment's not going to fall that much. Job creation is slowing because the firms that can expand have done it. Firms that have reopened have done it. Firms that can't, they're not going to do it. Now, restaurants aren't going to start opening suddenly and getting bigger all of a sudden. They're doing their best to hang on, and in some cases letting go of their workers, and that's what you see here. In terms of inflation, I just don't see it. Yeah, long-term expectations are up trivially. Commodity prices are up a little bit. I mean, we're getting out of this terrible recession. Something has to get more expensive, right? Restaurants, if a few of us go to restaurants, suddenly the restaurants are overwhelmed because they're only at 25% occupancy. So it's not surprising you're getting sectors where there's massive inflation and other sectors where there's no inflation or deflation going on. Airplane tickets, they're pretty cheap, right? So I'm very, very suspect of really massive amounts of inflation coming on. I really doubt it very much. So this is what the Fed wants to do. They're telling us they want to keep rates as low as they can, as long as they can. They control the short-term rate by determining it. The Fed funds rate, they decide what it is. They've told us they're going to keep it really low for a long time. They want investors to invest. They want investors not to be afraid that at the first sign of inflation, the central bank is going to raise rates. In the past, that was their mindset. Oh, unemployment gets too low. That's going to cause wages to go up, which will cause inflation. So we better raise interest rates in anticipation of the inflation. Now the Fed says, no. We've had that plan for 40 years. We're changing our game plan. Our new hymnal says, we're not going to raise interest rates until we see inflation actually happening. This means they're going to raise interest rates later than they would otherwise. And if long-term rates start to go up because of inflation expectations, the Fed will buy long-term bonds, push interest rates down at the long end. So I don't see rates going up even if inflation goes up. I simply don't see it. Now, let's change gears and talk about real estate. Whoa, real estate is like amazingly good. It's amazing. Rock on real estate. Yes, it's unbelievable. This is first-time mortgage applications put up by the Mortgage Bankers Association. You can see where we are now compared to where we were about a year ago. We're up 20%. Now, this 20% number, 24 this past week, data came out this morning, is pretty steady. That's where we are. That's the end of the line. I don't believe sales get a great deal better from where they are. They're very good. They can stay at this level. They'll go up a little more. Pending sales are really good. But we're beginning to get to the end of this process. It'll stay high. There's a big difference. It ain't going to come down because this virus is with us. People are sick and tired. They want to get out of where they are. They want to be out of the hot spot and get to the beach and get to a rural area, and get to the exurbs or suburbs or whatever it is. But home sales cannot, it's not going to reach 9 million here. I mean, remember, we'll get to some graphs here and I'll show you in a second. This is existing sales. So this is there's new sales and existing sales. This is most of the market. And you can see at the peak of the dot-com boom, when credit was incredibly easy to get, we were at 7 million units, right? Now we're at 6. So you can see we're getting closer than we are further away. When we were down here at 4, we had a long way to go. We went to 5, we went to 6. Maybe we get a little more. We'll get some more, 6.2, 6.3, maybe if we're lucky 6.4. But I think we're beginning to get to the peaking area. We're not terribly far from it. This is a remarkably good number. I mean, keep this in mind. If we end up at 6.3 or 6.4 million, that's going to bring us back to where we were in 2004, 2005. These are good numbers. Now, why are they so good? Part of the reason is there's nothing to buy. We're desperate to buy things. So anything that comes on, bidding war, people fighting to get the house, personal letters to sellers, sell it to us because we're nice people. Our kids will come and shine your boots or something. I mean, people are desperate to buy because there's so little inventory. If you look at this graph, you can see back in the global financial crisis of 2008-9, where my cursor is, there were almost 4 million units for sale at the end of a given month. This is NAR data. Look at the number now, 1.5. We're at 3/8 the inventory we once were. So what do buyers do? I can't find an existing house. I better go talk to a builder. I'll have a builder build me a house. So that's what we do. Look at the sales. These numbers are insane. Before the recession, we were where my cursor was. The recession hits, we fall down to here. And then, this is almost disturbing, the number is so good. It's now here. Yes, that's right. It's at over 1 million units sales compared to where we were beforehand, almost 800,000. It's 25% higher than where it was because there's nothing to buy. People want to buy a house. They can't. They go to a builder. The builder says, sign here. You sign. And the builder says, the house won't be done for 8 months because I'm booked up. Because the builders have no inventory either. Look at this graph. The global financial crisis, there were almost 600,000 units, new units for sale, either permanent in red and green, being built in blue, or built in red. Now there's nothing. We're at 275,000, roughly half where we were. New inventory is half as big as it was. Existing inventory is 3/8 as big as it was. There's nothing out there to buy. Any listing becomes an instant sale. Sales keep going up every month and inventory keeps going down. Days on market keep going down. Builders aren't building enough. They haven't built enough for 12 years. Here's the graph. Now, this is the global financial peak, the crisis. So builders are overbuilding here. They should be building at around 1.6 million, where my cursor is. So starting here, we're underbuilding by about this much. The distance between this line and the green line is how much underbuilt we are. So now that we're catching up, so we caught up in November, December, January of November, December last year, and then Jan, Feb of this year was right here where my cursors. Things were great. Home building was finally coming into its own. Things were looking grand. And then the crash happens, starts collapse completely, and then they rebound. Green is all starts. Red is single fam starts. They're well ahead of where they were. Blue is multifamily. It's moving along, but not going anywhere. And that's okay. We don't need multifam. There's lots of multifam coming online from permits that were issued before and starts that occurred before. And it's single fam that's being driven now by the pandemic. There are three forces driving home building right now, 3 or 4, whatever. There was pent-up demand from before the recession began. Sales were good. In November, December of last year, there were good. New starts were great, sales were good, and so on. Then there was pent-up demand from March, April, the lousy spring season that never really occurred. And then there was the coronavirus itself. People saying, oh my God, I'm locked in my house and I hate my house. I want a bigger house. I want to be near my parents, near my in-laws, away from my in-laws, near my friends, in the country, near a tree, near a pool, in the ground, all kinds of stuff. But builders have underbuilt this distance here, which is millions and millions of homes. In part, the major reason builders can't build is like regulatory costs are so high. It makes building a house inordinately expensive. You can't build an entry-level home. Builders have largely given up in that department. They do some, of course, but much less than they used to because the cost of land and regulation, land use, resulting in higher land prices, jacking up the price of the house. There's other factors going on. Labor's in short supply. Lumber was expensive for a while. Whatever. Now, the question is, will this persist? And the answer is yes, it will. Housing is the great sector in the U.S. economy. And it will continue because we have this K-shaped recoveries. I mean, as people talk about, there's the upper part of the K here and the lower part of the K there. These are people who have jobs, who can work from home, who are barely affected. The bottom part of the K here, people have to go to work. They're having a hard time. Home buyers are here. They're in the top part. No problems. So house prices keep going up. We're in the middle of the worst recession since the Depression. Very brief, very short, very steep, out of it quickly, but very, very profound. And yet house prices keep going up. They'll continue because there is short inventory and there's lots of buyers. There's demographic tailwinds that are coming. You can see it here. In this graph here, these are the millennials from here to there, all the blue bars. Yellow is prime age to buy a house. Some of the millennials are beyond home buying age. They may not own a house. Many are younger. More are younger. If you can see, the height of the light blue bars is higher than the height of the dark blue bars. The bulk of the millennials are now aging into home buying. These blue, light blue and dark blue drove multifam for a decade. Now they're going to drive single fam for the next decade. So you've got home price appreciation and lack of inventory. Now you've got demographic factors. I already told you and promised you interest rates were going to stay low. And we know pending sales continue to shoot the lights out everywhere. People are desperate for a house. They don't like where they live. They want to have a house that's pandemic proof, if you will, that allows for a place for homework and a Zoominar and a studio and an exercise place and a Zoom place and whatever. And on top of that, you might not know this, but getting credit to buy a house is harder now than it's been in the last 6 or 8 months. You can see for the last 8 or 9 years, it got progressively easier to get a loan. And the last 8 or 9 months, it got much harder. Imagine if it gets easier again. There'll be even more demand for people to buy a house. So this demand there's latent demand we're not even seeing because of the difficulty in getting a loan. On top of that, home buyers tend to be better educated. And you can see the impact here among those with a college degree or more in gold. And you can see the unemployment rates for them are under 5%. So they haven't been, as a class, terribly affected. On top of that, the stock market's doing well. I mean, my gosh, how much more do you need? Everything is clicking well. There's pent-up demand, low interest rates, demographic factors, house price appreciation, lack of inventory. Just as the last recession crushed housing, this one's just letting it rip, essentially. The only fly in the ointment is forbearance and delinquencies. But this is a very different story than last time. First, you can see here the forbearance numbers are actually declining. Overall, total is yellow here where my cursor is. You can see they were much higher 4 or 5 months ago, and they've steadily declined. People have either got current in their mortgage and got off forbearance, or turned those non-paid mortgages, monthly payments, into the end of the mortgage and are now off it again as well. There aren't many people who aren't paying and aren't in forbearance. Right? There are some, and they're the ones in trouble. But it's very few, and hopefully they'll get worked out as well. And even if you go to foreclosure on these people, the home price keeps appreciating. So the banks and credit unions and Fannie and Freddie, they're not losing money on the deal. They can let the person stay in the house till they sell the house. It'll be fine. They'll even get a check on the way out. A far cry from the way things were. Now, let's turn our attention and look at things locally here in Hilton Head and in South Carolina, North Carolina, whatever. You'll get the point. Unemployment, much lower here than the nation. Nationally, it peaked out around 14 or 15. You guys peaked out about 11 and a half. Now unemployment's almost 8, 7.9, but you're at 5.1. So you're better off. You were better off here. You're much better off here. So things are good and they're getting better relative to the country. That's good. And moreover, this is interesting. The next slide shows us labor force growth. And you can see this perfect seasonality, up and down, spring, winter, winter, summer, winter, summer, winter, summer, whatever. And you can see there's some confusion here, if you will, because of the coronavirus in March, April, May. It should have been ramping up. It didn't. But how about now? Now it's ramping up. The line is almost undisturbed. A little confusion there, as I mentioned, but not much to speak of. We're fine. You're doing great. No real problem there. Your labor force, people working and looking for work, is pretty much back where it would have been, it seems. And employment is moving up smartly. So at its worst, you lost 14,000 jobs. I have it up here. You lost 14,500 jobs. And you've made up about 10 of them. You've made up 70% of the job losses. The US has made up about 53 or 54% of the job losses. So you're way ahead of the country. Now, it's true, you're slowing down. It looks like you did some of that here, maybe here again, I don't know. But all in all, you're much better off in the country. Unemployment is lower. Your labor force has recovered. Your payroll growth, people actually working, is recovering more quickly. Home prices here through Q2 are well above where they were here at the peak back in 2008. End of 2007, actually. That's the end of 2007 where I'm looking at it. House prices are doing nicely. This is a good story. Population growth is good. This is very important. People want to move to Hilton Head. It's a popular place. It's a beautiful destination. It's somewhat rural. There's ocean. This is the great getaway from coronavirus. It's a great place to own a second home. It's a great place to retire to. If you can work from home now, like more of us can, well, let's move to a nice place. Hilton Head more than qualifies on that respect. So while the US population growth hasn't been particularly good, it's been really good here in Hilton Head. US last year was 0.6. Last year, you were at 2%, just about 3 times the US average. So you're growing much more rapidly than the country. And like everywhere else, there's absolutely nothing to buy in Hilton Head. Inventory has completely fallen off a rock cliff. It's like taking an anvil and just dropping it, right? A couple more slides and we'll be done. Again, this gives you now some notion of how good South Carolina is doing. We've talked about Hilton Head. Now let's open our scope a little bit and look at South Carolina. What do we see here? South Carolina is the state with the 8th fastest growth in its overall population. This is crazy. South Carolina is a really small state. Look at the size of South Carolina, barely 5 million people. You're competing with Texas and Florida. I mean, come on, that's a joke, right? You can't compete with them, so fine. But look at all these other states. You're the smallest, outside of Nevada, you're the smallest state here, and you're growing really fast. To put this into better perspective and look at the percentage increase in population. So we get rid of the size factor. Every state, percentage is what matters here. You've moved from 8th to 6th. You're growing at 1.3% essentially last year. That was twice as fast as the US. Hilton Head's growing 3 times as fast. Congratulations to you. You're a desirable place because in general, house prices are low, not so much in Hilton Head, but generally house prices are low. Taxes are low. Weather is good. This is what people want. They're moving from New York, New Jersey, Pennsylvania, south. And we can see this in the next graph. Where are people moving to? On the East Coast, if you think of East Coast as, think of it more as east of the Mississippi River. So the Mississippi River is right here, right between Minnesota, Wisconsin, Iowa, Illinois, Missouri, Illinois, Arkansas, Mississippi, Louisiana. On the eastern half of the country, these 4 or 5 states are the fastest growing. Virginia and Massachusetts are okay, but the Carolinas, Georgia, and Florida are the superstars. If you look at the western half of the US, west of the Mississippi, it's Texas through Idaho, right? Skip New Mexico and skip Wyoming, but Colorado, Utah, Arizona, Nevada, Idaho, they're the best. Washington, Oregon are pretty good. And these states out west are doing particularly well because California is crazy. They're taxing people like crazy. House prices are crazy. Weather's bad. There's no electricity, and there's lots of fires and forest fires. Who needs it? They're moving to Nevada where things are cheaper. To put this, to wrap it all up, hey, look, situation, this is first my name, cell number, phone number, email address, and Twitter handle. I put out 70 words every day on economics. No graphs, no ads, no charts, no links, and no photos. If you want to get it, you can email me at my email address there. And you can go to my website, Econ70, or text the word Bowtie to 22828. You'll hear from me every day. The economy is fine. We're slowing, but we will get some fiscal stimulus at some point, which will boost us up. And that will be followed by an injection sometime later. So by mid to late next year, things should be doing pretty nicely. The question is, how do we get from where we are to the government aid, and from the government aid to the injection? And housing is unbelievably strong. It has been a joy and a pleasure speaking with you. I encourage you to sign up. I look forward to hopefully seeing you one day in Hilton Head, and hope this conference has been terrific. Thank you very much again to Jean for the warm introduction, and the Hilton Head Multiple Listing Services, and Rochelle for all your assistance.
Thanks, Elliot, for being with us today. Some great information. You're always super enthusiastic, and we hope to have you here on the island one day soon. Thank you all for being here with us for Pivot with Power. Even though we all couldn't be together, I think we had a great day, and I hope you found some value in all of the sessions that we had. Until next time, bye.